Assalamu alaikum wa rahmatullahi wa barakatuh. Our student in business finance. Today we'll talk about the financial planning, but in this topic we'll cover only two issues, which is working capital, the cash conversion cycle, and the cash budget. So many topics should be covered here in financial planning, but because the time we will cover only two main issues. First one, cash conversion cycle. What do you mean by cash conversion cycle? We mean by that from the time we pay the cash until we return it back, this time we call it cash conversion cycle. That means, as you see at the bottom of the screen, this cycle, cash, we purchase a raw material or we purchase finished goods, whatever, and we manufacture or resell, then all these things will be transferred to be account receivable. We collect the receivable later. This is the cash conversion cycle. From the time when we purchase the raw material, we keep it, we manufacture, we sell it, account receivable, and collect our cash, return back our cash. That's what we call it by conversion cycle. So how we calculate or find the cash conversion cycle? It comes from three main points. It comes from the inventory period. We purchase the inventory, raw materials. So we talk about the inventory period. How many days, how many days the inventory stay in our stock? Equal inventory period plus receivable period. How many days our account receivable need to be collected? For how many days? Receivable days or period. Inventory period plus receivable period minus payable period. Payable period. Account payable, when we purchase, how many days we take until to pay the account payable? How many days we need to collect our account receivable? And how many days we keep the inventory in our stock? How we find the inventory period? We divided inventory at the end of the year, or we can take the beginning inventory plus ending inventory divided by 2. We take the average between the beginning and ending, or we take only the balance of inventory divided by the annual or cost of goods sold per day. Cost of goods sold per day. Cost of goods sold per day. How? We'll find the cost of goods sold and divided it by the 365 day in the year. We will get the cost per day. This is the, we could also put it here, cost of goods sold per day. And then come to the receivable period. Account receivable divided accounts receivable we divided it by the sales per day as well. Sales per day, annual sales per day, we could say. Annual sales, or yes, annual sales divided it by 365 days. Minus payable. We have account receivable for receivable, and we will have accounts payable divided by the cost of goods sold as the first one per day. This is the function to find the cost of the cash conversion cycle. We have example here, exercise number 1. In 2018, SOAR company financial statement include the following items. We have the inventory, receivable, payables, and sales cost of goods sold. All this information available to calculate the cash conversion cycle. Remember, we need the cash conversion cycle. How many days we consume to return back our cash. Inventory. According to the question, we have inventory 17,500 divided by the cost, the annual cost divided by 365 days in a year. Cost of goods sold in the question 41,600 divided by 365 days. It will give us 154 days. The inventory take around 5 months to keep it in our stock. Plus account receivable or receivable period. How many days our account receivable need to be collected? The balance of account receivable 23,200 divided by sales, annual sales 78,500 as well divided by 365 days. It will give us 108 days, more than 3 months, minus the account payable اللي هي 12,600 as well divided by the cost, the annual cost 41,600 divided by 365 days. We'll got 111 minus inventory period plus the account receivable period minus the account payable period. It will give us the total, which is 51 days. 151 days the cash needed to be returned from the day when we pay, around 5 months. Usually the company plan to minimize, to reduce this period. How? Through reducing the inventory period, account receivable period, and increasing the account payable period without damage the relationship with the supplier. We need to increase the credit period. We need to delay our credit, but without damaging our relation with the supplier. We try our best to minimize, to reduce this period, to collect or to use the inventory frequently, and in short period minimize it, and minimize this one, reduce it, as well increase this one. By this way we could also reduce the days of a cash conversion cycle. That means our cash is working, just take few times to return back, and we reinvestment again and again, and each time when we reinvest, definitely we'll get a benefit and revenue. This is the idea of cash conversion cycle. Now we'll go to the second issue, which is the cash budget. another issue related as well to the cash. Cash budget should be also prepared at the beginning of each period, monthly, quarterly, semi-annually, annually, to specify how much cash we will receive and how much we will pay, the difference. That's the idea of the cash. So as you can see, there's 3 steps to find the or to prepare the cash budget. The first one, estimating or forecasting of the source of cash. From where the source of cash, from where we will collect the cash, from our sales, cash sales, or collecting the credit, the account receivable, and from our customer. Forecasting the sales or the cash. Second step, forecasting use of cash. Where we will use the cash to purchase an inventory, to purchase the raw material, to pay the salaries, to purchase fixed asset, machine, furniture, whatever. This is the another use of the cash. So between the source of the cash and use of the cash, there will be a gap. Either surplus, if the source more than the use, that means we have surplus. So we have to find somewhere to invest it. On the other hand, if the use of the cash more than the source of the cash, there will be a negative. There will be a deficit, they call it deficit, a shortage. So we have to find some source to finance this deficit. Calculating whether the firm is facing cash shortage or surplus, if they have deficit or surplus. We have a question here. Yes. Company forecast sales, and this is the first part of the cash budget. It's not a cash budget, only for the first step, estimating the or forecasting the source of the cash. The company has forecast sales in the first 3 months of year following in million: January 60 million, February 80 million, and March. 60% of sales are usually paid for in the month that they take place, and another 40% in the following month. They collect 60% in the same month of sale, and another 40 collected in the following month. Receivable at end of December 24 million was the forecasted collection on account receivable. We'll find it not in March, in the 3 months. All right. So we have sales for 3 months. Cash sales. How much? 60%. And the credit sales on account receivable collected in the following month, which is 40%. We have a data related to January and February and March for 3 months. So the first month, January, the sales here, we could put it here, 60 million. They estimate to sell during the January, but as their policy, as their information, they collect only 60% in the same month. That means from 60 million, they will collect 60%. So 60 million times 60 percent, it will be 36. It will be collected now. What about the another 24? 40%, it will be collected in the following month. Where? In February. It will be collected here. This is the 60 million. 60% of it collected cash direct when we sell, and the remaining 40% collected after it will be collected after 1 month. Related to the February, we have 80 million. They will collect 60% of it. 80 million times 60%. So they will collect 48. 48 will be collected in the same month, and another 40%, which is 32. So the total of these two numbers is 80. The total of these two numbers is 60 million. Collected 60% of it in the same month, and the remaining 40% in the following month. March, how much they sell? 100. They will collect 60%, so 60,000. 100 multiplied by 60%, it will be 60 million. What about the 40 million? It will be collected in April, but it's not related to our question now. What about the credit sales here? From where it will come? It will come from January, and we have information about January. Receivable at end of December were 24 receivable already. 24 million. They will collect it because at that time they sell during December, they collect 60%, and the remaining 40%, which is 25, they will collect it in January. Now we could find the forecasted cash source, or the cash that will be collected within the first quarter, within the first 3 months of the year. 60 million in January, 272 in February, and 92 in March. The source of cash. If you want to continue to find the cash budget, we have to do the second part, the use of the cash. How much they will say as a salaries, how much they will say to purchase raw materials, how much to all these expense should be specified for each month. And between the source and the total use, there will be a difference. As we said, it could be shortage or surplus. That's it. We will stop here, and as well you will find some exercise on the model to do it by yourself regarding the cash conversion cycle and cash budget. I wish to do it by yourself, and we will discuss it later inshallah. Assalamu alaikum.